Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for today's show, David Blain. We thank you for joining us here on 94.1 FM WNBU as well as Cable TV 10 in New Bern. And today, the day after, as I record this, it's the day after the tax deadline. I was just talking with our engineer here in the studio, Bob, who does an excellent job, by the way, of keeping us on both the radio and the TV. But we were just talking about filing taxes. I hope you didn't forget, but yesterday was the deadline in case you did. And that's all over for another year. If the paying of your taxes was sufficient, I hope that you will complain to your congressman if you think the tax code was too complex or you paid too much. Now's the time to, while it's fresh in your mind, to remind our Congress people of that fact. So, we've got a great show lined up for you today. I think for me, the day after tax season, I'm in a little really good mood, and I thought we'd cover a few things out of the ordinary today. May touch a little bit on the stock market. Yesterday, Standard & Poor's announced that they were putting the U.S. on negative credit watch. And what does that mean? In case you missed it or you saw it yesterday and don't understand it, we'll take a few minutes and explain what that means. But Standard & Poor's is a rating agency that rates debt, the bonds of companies like GM and Coca-Cola, as well as municipalities such as the state of North Carolina. They also were in the news recently, a couple of years ago, because they were rating these mortgage-backed securities that imploded and had a lot of the cause behind the financial collapse. So keep that in the back of your mind as we go through this rest of this story. But so there's Standard & Poor's, Moody's, and Fitch. These are the three big rating agencies. And so they look at the finances of companies. I forgot. They also rate the debt of countries. The U.S. as well as I think 130-something countries around the world. They analyze the sources of income, whether it's a country or a company or a mortgage bond. They analyze the sources of income, they analyze the liabilities of that entity, and they give it a rating. And the ratings are a little bit different depending on the different agency. But at the top for Standard & Poor's is what's called a AAA rating. And then it goes down to AA, single A, and then on down to a D-rated, which if you see something D-rated, you better know what you're doing, because D in the bond world stands for default. It means that the company or country is currently in default and they are not making their interest payments. So what Standard & Poor's does is they assign a rating. And so the United States Treasury debt is rated AAA. It's the highest rating that they can receive. I believe there's about 10 or 12 countries that still receive a AAA rating around the world. There's a few companies that do as well. And what they do, instead of just waking up one day and all of a sudden say, okay, this company is no longer AAA, it's now AA, and sending the market into a panic, they put securities on what they call rating watch, that if the situation is sufficient for them to look at a downgrade or an upgrade, they put out what's called a negative watch or a positive watch. So obviously if you're AAA, there's going to be no positive watch. You can't go up. But if you're AAA rated, such as the U.S. debt, and they're looking at some of the factors, are ballooning deficits, are deficit spending on an annual basis, which is running north of $1 trillion, or our aggregate debt, which is north of $14 trillion. And they look at these factors and they say, hey, we need to put the U.S. on negative credit watch, meaning that within the next year or two, there's I think they cite a 1 in 3 chance of downgrading the debt to AA. on the flip side, let's say you're a company and you've got a AA rating, or a country that's a AA and you're improving your finances, they could put you on positive credit watch. So it does not mean that they downgraded the debt. It just means that they are putting on a watch for a potential downgrade. This has huge implications. Of course, the Treasury Secretary Geithner came out and said, we're not going to lose our AAA rating. A lot of the people around the world that hold U.S. Treasury debt came out and said, well, we're not really concerned about this. But it's significant in that, 5 years ago, no one would ever imagine that the U.S. would even be considered for a downgrade on their debt. So it has big implications, something that we'll be keeping an eye on. One of the fascinating things, this announcement came out yesterday, and so the global markets went down, the stock markets went down in response a lot to this news that was announced. But when you look at the U.S. dollar, the U.S. dollar itself yesterday was trading up. In fact, at one point it was almost up 1% against foreign currencies. And why is this? There are a lot of reasons, none of which work all the time. And my point of this is you would think that a potential downgrade in the U.S. debt, which would devalue the dollar, would cause the dollar to decline against other currencies. In fact, we had a lot of questions the past several months or even years about, well, should I put my money in euros, or should I put it in the Bahamas or something like that? And this is a perfect example of, at least in the short to medium term, when crisis hits around the world, people still, for whatever reason, go to the U.S. dollar. And even an announcement of the possible downgrade of U.S. debt, and the dollar actually went up. The other thing to consider, a corollary to this, is if you're considering putting your money overseas, but don't live overseas, at some point you have to buy gas and food and pay your rent or pay your mortgage in U.S. dollars. And so you have to repatriate that money to the dollar. So unless you're going to be spending money in a foreign country, it doesn't have the same effect as you might think. If you put your money overseas, you still got to bring it back into U.S. dollars. So if the U.S. dollar purchasing power does get eroded, you still have to purchase things in the dollar. And so you can invest overseas in foreign denominated currencies, a good hedge against the dollar, and can help your assets appreciate. But just remember that at some point, if you're living here, you're going to have to bring that money back in dollars to actually spend. We do have a lot of our clients' money overseas in foreign stocks and bonds, but to just park all your money overseas when you have to live in dollars is not a strategy that we advocate. Okay, well, we're coming up on a break here. I just wanted to go over that little news item that happened yesterday that's of some interest. So we're going to take a break, and when we come back, we'll talk a little bit about inflation. So for All Things Money, I'm David Blain.